morning, friends. Welcome to video series on financial freedom. Friend, I am Ramchandra and you are watching Prayas Vikalp. The channel fully dedicated for development of your personality, financial intelligence being integral part of the personality. So far I have discussed how to achieve financial freedom before the age of 35. What are 5 things you should know before investing? What is magic of compounding? What are things you should know about dynamics of money? What financial options are available? What investment options are available before you? And in the last video I discussed the safety circle of fixed deposit in today's volatile economic condition. Friend, in this sequence today I want to discuss the financing system of corporate or businesses in which you can participate as an investor. Therefore, you should understand the fundamental system of financing and its nature, risk. Therefore, I will request you to please be with me throughout this video so that you can understand this particular system of financing and you can select your own place in that as an investor. Friend, whenever an entrepreneur wishes to start a business, he tries to find out from the market that what type of services or product are in demand, what type of critical gap he is going to fill in the market, which is really required by the customer. Then he tries to estimate the price at which he can sell. After preparing a techno-economic feasibility report, business proposal, and if there is a sufficient adequate demand in the market to achieve a economy of scale, and the customers are ready to pay the price at which the unit can become financially viable, profitable, then it is said that this idea is commercially viable, financially viable, and can be financed. Of course, business is very risky. Nobody can say whether it will survive or not. But he tries to understand the risk and tries to manage it. Now, having done this, he tries to estimate total fund requirement. Let us suppose he requires 100 crore rupees. Then he has to take a call whether how much money he will invest as equity, how much money he will invest as a debt or loan. Now suppose he wants to invest 1/4 as equity, that is 25 crore he will arrange as a share capital either on his own or through family member or others, shareholders. This is a total risk capital. If the business performs well, it is profitable, then he can earn a lot on his share. If not, the whole even investment can go down the drain. What to talk of dividend? So it is a very risky investment. So far debt part is concerned, either he can issue debentures at a fixed coupon rate. If the debenture is secured one, that is secured by some asset, then the interest coupon rate will be lower. If it is not, so it will be higher. He can take direct loan from the bank, repay interest and principal as per the terms and conditions of loan. He can get the margin money, working capital sanction from the bank. Now, one very important thing you should understand, what I have discussed in my second video, that is PD 79, that is called trading on equity. This you should understand. In that video, I have given an example that suppose he has taken loan at the rate of 10% from the bank, or maybe he is paying 10% coupon rate on the debenture, which he has sold to public. And the corporate income tax rate is 25%. Now you should know that the interest paid in a financial year or coupon rate paid in a financial year is a business expense. It is financial charges and it is tax deductible under profit and loss account. So if 25% is the tax rate, he will save tax to that extent. That means he is going to save tax up to 2.5%. So the real cost of debt is not 10%, actually it is only 2.5%. 7.5%. Now suppose he has an overall ROI of 10%, but he has paid only 7.5 for the debt part. So 2.5% saving what he has done there in his tax is going to be added to his profit. And the direct beneficiary will be shareholders, equity holders. So his rate of return will be much more than 10%. Because only he has only 1/4, 3/4 is loan, and on that 3/4% he is saving 2.5%. So this is called trading on equity, which can magnify return on equity. Therefore, every business will take some debt to get benefit like this, and there will be always a demand for debt investment, whether in form of debenture or fixed deposit, company fixed deposit, or bank loan. So people who have got risk aversion, whose risk appetite is very low, they will certainly select bank FD or fixed return investments. So they have a scope there. And equity part is very risky. So debt equity ratio and trading on equity, these two things are very, very relevant. Now you as an investor, even if you decide to invest in a fixed deposit of a company, you carry a risk that you may select a wrong company. Company may default, company may fail. So you may lose your deposit as well as the interest. Even if you invest in debenture, same thing can happen. The only difference between debenture and fixed deposit is that fixed deposit are not tradable. You cannot trade it and get out of it. It will mature only at the end of the period what you have selected. Whereas in case of debenture, you can trade it, you can exit whenever you want at some price with some loss or profit, and you go on getting coupon rate. If you have invested in equity, you have taken much bigger risk. If the company does well, you are rich. If it does not well, you may become poorer. Therefore, there is a now middle path has been cultivated, that is called mutual fund. Now you have got an intermediary between you and the company. They collect money from investors, and then they have a team of experts who are deciding, examining companies, and their track record, entrepreneur track record, and business prospect, and everything. And then they very selectively invest. And they diversify investment in so many companies so that even if company does not do well, overall impact will not be so adverse. So overall stability is maintained. So as an investor, you can decide either invest directly in the company through its fixed deposit, or you can go to share market, invest in debenture or share. But the risk is yours because you have to select. So if you don't have the expertise, you can't do that. So you have to put your money to some mutual fund, and that mutual fund will decide where to put money, about which I am going to discuss in my further videos which I am going to bring on this subject. Friend, I hope that you have been, now you know that if I am going to put my money in a company, what can happen to my money? What options do I have? Friend, more the risk, more the return. I have already discussed this in my second video itself. So depending upon what type of risk you want to take, you can take a call and you can invest money, earn better money. Friend, before I part, I want to request you that if this video has been of any use to you, please like it, share it, and subscribe to our channel if you have not done so far. Because I am going to give you one video every week. Friend, health is wealth. Please take care of your health, mental, physical, both, by adopting healthy lifestyle. And second most important thing, you must improve yourself, improve your personality every coming day, so that you can have a better skill, your income can improve, your saving can improve, your wealth can increase, and you can be free from financial worries. You can achieve financial freedom. Friend, thank you very much for listening me for such a long time. Thank you again.